In the last week, the Strait of Hormuz has been opened and closed multiple times. Iran imposed its blockade on commercial shipping, and the US maintained its own blockade on Iranian ports, both sides applying pressure simultaneously. One moment we have Iran's foreign minister saying it was fully open, with Trump reinforcing that view, signaling that peace talks were progressing well. Hours later, the IRGC shut it down again, tankers turning around in the Persian Gulf, and we had reports that 2 vessels were hit. This is not a ceasefire. This is a negotiation being fought with gunboats and oil prices. And the ceasefire that was supposed to resolve this, it expires this week, and the deadlines keep getting extended. And yet, through all of this, equities broke all-time highs last week. Oil has given back a meaningful portion of its gains, and markets appear to be pricing in a successful deal. That is where the danger lies. The market may be underestimating the downside risks, even if it eventually proves to be right. So the real question is, what is the market actually pricing? And more importantly, how should traders and investors navigate this kind of uncertainty? I'm Joseph AuXano from Team DiNapoli, and welcome to EBC Pulse360. To make sense of what's happening, we need to simplify what really matters. Because despite everything we are seeing, missile strikes, negotiations, ceasefires, it really comes down to one key variable: the flow of energy through the system, specifically the Strait of Hormuz, a critical choke point through which a significant portion of global energy and trade flows through. Now, a lot of the discussion focuses on who controls the strait. And from a market perspective, control is not political, it's operational. It simply means, can energy continue to move safely, consistently, and at scale? And perhaps more importantly, who is perceived to have the ability and the power to decide that? If that flow remains intact, the global system continues to function, and if that flow is questioned, the market begins to reprice risk, and that's where everything starts to shift. So control over the Strait of Hormuz is critical, but the deeper question is, can this really be resolved with an agreement? Going into this conflict, from the US perspective, it was anticipated to be a short engagement. Apply maximum pressure, bring Iran to the negotiating table, and resolve quickly. But that assumption is now clearly being challenged, because from Iran's perspective, their strategy has always been structured to sustain and operate under prolonged pressure, which creates a clear misalignment between both sides. The US is positioned for a short war, believing Iran will ultimately cave after devastating US missile and bomb strikes. Iran, however, is preparing for a war of attrition, betting that the pain inflicted on the US administration will become too costly to sustain given upcoming midterm elections and the American public's limited tolerance for the loss of lives and money. And because both sides still retain leverage, negotiations have stalled and deadlines continue to be re-extended. And understanding why this matters requires looking at what's actually at stake. Ultimately, what's at stake here goes beyond the conflict itself. It comes down to control of a critical global flow, the Strait of Hormuz, and more importantly, how that control is perceived by markets. Because once that perception shifts, confidence becomes the variable that matters most. If Iran can credibly threaten that passage, markets don't just reprice oil. They may start questioning American power and dominance itself. And when that doubt enters the system, the consequences move fast. US debt gets sold, the dollar weakens, gold gets bought, and equities reprice. We've seen this pattern before. In 1987, Reagan faced almost a similar situation. The Iranians attacked oil tankers and shipping lanes were under threat. His answer was Operation Earnest Will, US Navy escorts through the Persian Gulf. It wasn't clean, but Iran stood down. Markets read that as a signal. American power is credible, the flow is protected. And that confidence supported the dollar. It supported treasury demand. It supported the entire financial architect built around US dominance. Lose that signal, and you're looking at the reverse. Dollar weakness, treasury selling, US equities collapsing. Those aren't just geopolitical outcomes, they show up directly in your portfolio. If Iran retains control of Hormuz, that doesn't just affect oil prices, it tells every US ally in the GCC region that America will not show up when it matters. And that perception spreads beyond the Gulf, to Europe, to Asia, to every relationship built on the assumption of American reliability and dominance. In markets, that's not just a geopolitical story, that's a confidence story. And confidence moves capital. Iran is not trying to win a direct confrontation. They are trying to outlast one. The pattern is deliberate. Drag it out, make it painful, and wait for American political will to collapse. Because in a war of attrition, the side that can absorb more pain wins. And Iran is betting that America reaches its limit first. This conflict is not being watched in isolation. China is watching, Russia is watching, the rest of the world and Europe is watching. Because the outcome here doesn't just determine what happens in the Gulf, it sets the precedent for what America will and won't defend. Great powers don't decline in a single moment. They decline through a series of moments where the gap between their commitments and their capacity to fulfill them becomes impossible to ignore. This may well be one of those moments where the US is exposed as both financially and militarily overextended. Or it may be the moment the US reasserts its dominance and restores confidence in the dollar and the system. But either way, markets will price the answer before the headlines confirm it. But there's one more factor to consider that determines how this plays out. Not just control over the strait and trade flows, but the duration of the conflict. Because markets can absorb short-term disruptions, but if uncertainty persists over time, it begins to affect inflation, financial conditions, and ultimately how assets are priced. So the question now becomes, is this a short-term disruption or a more prolonged environment of pressure? If this proves to be a shorter disruption, markets can stabilize over time. But if this evolves into a more prolonged environment, pressure begins to flow through the system differently. In that type of environment, energy carries a risk premium, inflation pressures remain elevated, central banks have less flexibility, which keeps financial conditions tighter than expected. And importantly, this isn't just about oil. When energy flows are disrupted, it affects logistics across the entire system, from shipping to industrial gases like helium to fertilizers like urea, and that feeds directly into the cost of food, semiconductors, and everyday goods. So inflation pressure becomes broader the longer this environment persists. It's not just the immediate shock, it's the duration of pressure that matters. And here's the critical point. Markets may well be pricing in an eventual resolution, but they may be seriously misjudging Iran's resolve and mispricing the risks to the global economy and financial system. That is why traders and investors need to approach this situation with clarity and be prepared for what comes next. But how does that pressure actually move? When a shock of this scale enters the system, it doesn't stay in one place. Oil and energy markets move first. Inflation pressure builds up behind it, and yields stay elevated. Watch the dollar, and equities reprice based on where expectations are anchored. These are not separate moves. This is one interconnected reaction chain across the system. And once you see it that way, you stop reacting to individual headlines and you start reading the system. Which brings us to how we simplify all of this. There are three key forces driving everything that we are seeing: flow, confidence, expectations. Flow moves through oil, inflation, and rates. The confidence shows up in the US dollar, treasury markets, and the broader financial system. So if you look at the flow through the financial system with this lens, the real question becomes, are investors still confident in the US-led global financial system? And expectations will determine how markets price the future. This becomes the lens to understand what is actually driving price and where it may be heading next. So far, we've talked about the macro picture, the conflict, the stakes, the pressure building in the system. Now, let's look at what price is actually telling us, because at the end of the day, price is always right. We'll walk through them in this order: crude oil, the US 10-year, the dollar, and equities. Reading these markets separately, they each tell you something. Read them together, and they tell you everything. We start with crude oil, because energy is where this story began. Since the conflict started, crude moved from around $65 to a recent peak of $120, nearly a doubling within weeks. And since then, during this ceasefire and negotiation period, we have seen significant volatility, trading in a range between $80 and $120. Recently, finding support at what we call the agreement zone. And for traders bullish crude oil, structural support sits around 67.50, near the 200-day moving average. A bullish bias is maintained above this zone. If the strait reopens sustainably, oil should stabilize, possibly trading back below its 200-day moving average. But if the strait stays disrupted or this becomes a more prolonged environment, the next structural resistance comes in around 160.69 and the 180 level on the higher time frame charts. Oil is the first signal. Watch whether it stabilizes or continues pushing higher, because that tells you which direction this is eventually heading. And energy feeds directly into the next signal, the US 10-year. Because if oil stays elevated, inflation risk compounds, and that puts pressure on yields. On the quarterly chart, the 10-year has been consolidating around its 200-day moving average. And as long as it stays below its 200 MA and below recent structural highs, inflation risk remains contained. And that's the signal that the system is holding. But if the 10-year breaks above its 200 MA and above structural highs, that would be an early signal that inflation pressures are building further. And here's the critical question when that happens. Is it rising because of inflation pressures or because of a shift in how markets perceive the stability of US debt? Both lead to higher yields, but they have very different implications for what comes next. Because if the Fed is forced to raise rates, that adds further pressure to a US debt situation already dealing with higher financing costs. So the 10-year is the second signal. Watch whether it pulls below structure or begins breaking above it. Which brings us to the dollar, because the dollar is where confidence shows up. The dollar index recently tested its 200-day moving average and long-term trend line, and it has held above both, signaling stability for now. And price is also staying above important DiNapoli level support. Here's what's important to understand in this environment. In a risk-off environment, the dollar typically strengthens. Investors move toward it as a safe haven. So dollar weakness here would not be your typical signal. It would be an early warning sign. It would suggest that safe haven demand is beginning to weaken, and if inflation rises, yields pushing higher, the debt situation becomes more pressured. And if the dollar starts breaking below recent structural lows, that becomes an early signal of something more significant. A shift in confidence in the US dollar and, by extension, the broader US-led financial system. So the dollar is the third signal, holding above structure, confidence intact, and breaking below confidence question. And now, equities, where everything converges. I was actually short this market going into the US-Iran conflict, watching a pre-identified DiNapoli support area at 6349.25. And the markets bounced off that level. And more importantly, from a technical perspective, the E-mini S&P futures have since made all-time highs. And the market appears to be leaning towards a resolution scenario, a deal, a reopening of the strait, and stabilization. That may well be correct, but at all-time highs and given the fragility of the current situation, the market may be underestimating the downside risks associated with a breakdown in negotiations. If negotiations fail, and this becomes a more prolonged environment, strait disruption continues, energy prices stay elevated, and inflation pressures intensify, and financial conditions tighten further. Broader confidence in the system may come under pressure, and in that environment, equities become significantly more vulnerable. Here's the technical picture right now. Multi-time frame trends are up, and momentum is still to the upside for now. In the short term, price is always right. Respect it. But, and this is important, while the rally is technically valid, the macro risks are quietly building. Those two things can coexist until they don't. If we continue to trade higher from here, there's significant higher time frame resistance around 7644.5, and at that level, we can expect meaningful resistance because this is where the technical picture meets the macro picture, and the market will have to resolve that tension. So when you step back and look at the full picture, the market is not reacting to the event itself, but is pricing probability. On one side, a possibility that conditions stabilize, confidence holds, and the markets continue trading higher. And on the other, the risk that pressure persists, confidence weakens, and markets begin to reprice. And right now, price is telling us that the market is leaning towards the first scenario. But that can change very quickly. So how do we hold both of those realities at the same time? By understanding that we are operating across two different time horizons simultaneously. A trading mindset focused on shorter-term price action governed by risk management and system design. A portfolio mindset focused on longer-term macro outcomes governed by diversification, capital allocation, and portfolio rebalancing. What equity markets are doing right now is simply the expression of that balance. If confidence holds, markets can continue higher. If confidence weakens, markets will price. Price leads in the short term, which is why markets can be trending higher while longer-term structural risks are quietly building. If you understand which lens you are operating from, there is no contradiction. And once you learn how to read the system, what is moving, what is holding, and what is changing, markets become a lot clearer. The framework we walk through today, flow, confidence, expectations, gives us a basis to understand the markets, both collectively and individually. Because understanding the macro picture is one thing, knowing where to act on is another. For traders looking to go deeper into how we apply this framework to the charts using DiNapoli levels, can explore our DiNapoli Academy online program. And we are working closely with EBC to make this available at the EBC Trading Academy soon. Stay connected with us here on EBC Pulse360, where we continue to explore both the macro landscape and practical trading insights. My name is Joseph AuXano from Team DiNapoli. Thank you for tuning in, and we'll see you in the next episode.
The content of these materials does not constitute a recommendation from EBC Financial Group and all its entities, also known as EBC. EBC is not providing any financial, economic, legal, investment, accounting, or tax advice through this material. The views or opinions expressed represent those of the speaker and not necessarily those of EBC. This material, regardless of format, should not be copied, shared, or reproduced in whole or in part without written consent from EBC. Past performance is not a guarantee of future results. EBC does not verify the source or accuracy of all information presented and disclaims all liability for any direct or indirect loss arising from its use. Receiving this material does not make you a client of EBC or constitute investment advice. Trading Forex and CFDs on margin carries a high level of risk and may result in significant losses, even losses exceeding your initial investment. Please ensure you fully understand the risks and seek independent advice where needed.